Hey investor friends, I'm Michelle Markey, and just when you might have thought that things couldn't get that much worse for Alibaba and Chinese stocks, they definitely can, and they did in the week ending March 11, 2022. And it reminds me of a Paul Newman quote where it's always darkest before it turns absolutely pitch black. And that's what it seems like these Chinese stocks are being treated like in the markets, as they've declined even further than what we might have thought were already really oversold positions. But things can always get worse, I guess. So it begs the question, are some super investors like Charlie Munger or Bill Miller or Ray Dalio wrong on Alibaba and other Chinese equities? So I'll actually talk about the latter two, Bill Miller and Ray Dalio's thoughts on Chinese stocks, and also go through what I think is going on. And if you appreciate content like this, please be sure to like and subscribe to my video and YouTube channel, because I greatly appreciate it, and I do my best to study super investors to see if they're going to be right or wrong in the long term. So thanks. So what happened that caused a massive sell-off in Chinese stocks recently? Well, if you take a look at BABA's stock price on Wednesday, March 9, you can see it was trading at around $100 per share. And then by Thursday, March 10, a couple of things happened that caused Alibaba's stock price to plummet by 8%. And then on Friday, it plummeted by another 6% down to $87 to $88 a share. And what happened on Thursday was that its fellow e-commerce rival, JD.com, reported a fourth quarter 2021 loss, as well as its weakest revenue growth in 6 quarters. So it sent JD.com's stock price tanking by 20%. And then in addition to this, the U.S. Securities Exchange Commission added 5 Chinese companies to its provisional list for failing to provide access to audited financial documents. And these 5 Chinese companies include fast food company Yum China Holdings, tech firm ACM Research, biotech group BeiGene, Zai Lab, and also pharmaceutical company Hutchmed. And although these companies are not nearly as big as some of the biggest cap stocks like Tencent and Alibaba, they still had a tremendous impact in scaring a lot of investors from investing in Chinese companies. So it sent a lot of Chinese stocks down, and especially the stocks that have been in question lately. So you can see that all around there's been a lot of pain, but just like anything else, not all Chinese stocks are the same, and there are certainly reasons why some stocks like Didi have plummeted more than others, as Didi has basically been left for dead. And also you have to consider, how rational is it for the stock prices of some of the largest Chinese companies like Alibaba and Tencent to be affected by the actions of some of the 5 Chinese companies that are currently in the hot seat with the SEC's Public Company Accounting Oversight Board, because those companies are much smaller than the likes of Alibaba and Tencent, where the biggest one of these 5 currently on the provisional list are BeiGene and also Yum China, which have market caps of around $16.5 billion respectively. So even though they're in the smaller area of large cap stocks, that's much smaller, as they're only ranked 90 and 92nd right now on a list of the largest 194 Chinese companies. And also the other 3 are only small to mid cap stocks and having market caps of only $1 to $3 billion. So you have to ask yourself, how meaningful is it that their actions are currently taking down the stock prices of some of the biggest well-respected Chinese companies? And also these companies can easily make up some of their current reporting shortfalls by providing the necessary access, and it looks like they're on track to doing so, according to, if you believe the Chinese Securities Regulatory Board, and if they provide the right audit documents within the next couple of years, then they probably won't still be on the US SEC's list of companies that could be at risk of being delisted, because if companies don't provide the required financial audited documents, then they could be at risk of being delisted. And this concern has always been there. Like with any Chinese American Depository Receipt or ADR, there's always been that delisting risk, and this is not a new risk. So even though Alibaba and any other Chinese company stock could easily be delisted if they don't comply with either US or Chinese regulatory expectations, it doesn't seem likely that this is a real risk for Alibaba at this time. And should we believe this well-respected value investor named Bill Miller, who recently said that Alibaba is the cheapest big cap stock in the world? And Bill Miller was known for running Legg Mason Capital Management for decades and also for beating the S&P 500 for 15 years straight until 2008, when his Legg Mason funds lost 2/3 of their value. So it seems like Bill Miller is known for some extreme losses and gains. And nowadays he runs Miller Value Partners, which has about $2.8 billion of assets under management. And Bill Miller seems extremely bullish on BABA because it's its 15th top position out of 94 positions. And he's got about $80 million invested in BABA. And so let's listen to his investment thesis on BABA as he explains to Consuelo Mack of Wealth Track in the following.
Alibaba, just speaking of a company that has come under scrutiny in its home market in China, has been, certainly the stock price has been affected by that and regulation from the Chinese authorities, and yet you continue to own it in a fairly sizable position in it. Why?
Yeah, we bought a chunk of it when all of the stories broke about Jack Ma, and he disappeared for a while. Mm-hmm. There's still stories every day. There's a story today about the common prosperity that President Xi wants, and the new regulations for things like DD and gig workers, and all of that is real. We don't know how far that's going to go, but right now the market price, in my opinion, fully reflects that in Alibaba, for example, because it trades now about 15 times the next 12 months earnings, and we think the company's growth is going to slow, but it would be surprising to us if over the next 3 years they couldn't grow at least 15% a year, generate a lot of cash, still have a dominant market position.
How do you deal with these political uncertainties?
There's a couple aspects to that. The first one is we really try and understand, based on what we know now, about what the economic impact of those measures will have on these companies. So how will it affect their earnings growth? I mean, Alibaba was growing 25% a year, 30% a year for a long time, and now it's going to be growing a lot less than that. Mm-hmm. But again, that's now reflected in the price. And then the other part of it, might have said, or if I didn't, I should have said, that since the financial crisis, people have been volatility and risk phobic, and so wherever they see perceived risk, they flee from it because of the experience of the losses in the great financial crisis, 08 and 09. So our default position is that people will overestimate perceived risk, and the real risk tends to be much less, and especially when there's a lot of headline risk about these companies. We had a big position in Facebook some years ago when Mark Zuckerberg was dragged before Congress, and we went over to see clients over in Europe, and they asked us about it, and one of the things that we said, well, what are your other managers doing? And he said, well, they're all getting rid of it. And that turned out to be, that week of it turned out to be the bottom, and then Facebook's price. So Alibaba was 300 a year ago, and now it's 120. So that come down reduces a lot of risk in that name and other names in that space. I think the concern for us would be that something would happen that happened with the education companies, where the party just turned them into nonprofits.
Shut them down.
And so my take on what Bill Miller said is that it seems like a lot of the political risk and a lot of the financial punishment has already been baked into Alibaba's stock price, because in 2021, Alibaba was dealt with the $2.8 billion antitrust fine, as well as the Common Prosperity Fund, which will cost them $15.5 billion over 4 years. So as some of those cash flows have been taken out, now it seems like Alibaba can focus and concentrate on growing their businesses in e-commerce and cloud from here on out. And so maybe things are going to be on the up and up. As Bill Miller said, it would be a surprise if they couldn't grow by at least 15% per year. And even though that's a step down from having grown from 25 to 30% per year, they still seem to have a bright future in being able to still sell to more than 1 billion Chinese consumers and also grow their cloud throughout Asia and also the world. And so hopefully things will get better for Alibaba in the upcoming years. And should we believe billionaire hedge fund investor Ray Dalio, who runs the Bridgewater Associates hedge fund with $223 billion of assets under management? And Ray Dalio is also known for his principles of radical truth and radical transparency, and also for his latest book, The Changing World Order. And he also said that
almost everybody's underweighted China. So if you look by any of the benchmarks relative to world capitalization, and it's also a normal thing because over periods of time, the reserve currency, everybody wants to save in it, the world capital markets, you invest there. So it's underweighted. The first move is to get exposure to China, to get exposure in a diversified portfolio. That means to achieve the right kind of balance of assets in China. Our approach is, we call it an all-weather approach. It's a certain balance in which you achieve balance without lowering the expected return. From that, you want to make the tactical moves. And of course, those change depending on the relative pricing of assets, classes, and so on. But first, to get the exposure, I believe,
Right.
to those markets and the currency too.
And so my take on Ray Dalio's approach is that he seems to be putting his money where his mouth is, because even though the equity holdings of the overall Bridgewater Associates might not be super huge, it is significant to me that his Alibaba position is his top 8th position out of hundreds of positions that Ray Dalio could have invested in. And also he's bullish on other consumer staples like Coca-Cola, Pepsi, McDonald's, Procter & Gamble, Johnson & Johnson. And this is in addition to his overall belief in the S&P 500, so he's invested there, as well as he's also put a lot of money into emerging markets as part of his top 10 holdings. So although he's really into having diversified portfolios, he overall is very bullish on the future of the Chinese economy, and so it shows in his tremendous investment in Alibaba at over $500 million. So I think that's very interesting, and only time will tell if Ray Dalio will also be correct. With Alibaba now at 5-year lows, it definitely makes these super investors' investment thesis really interesting and fascinating to study, because you have to go back to 2016 to see Alibaba at the same price, and that's not even adjusting for inflation. So most likely Alibaba is maybe even at 6-year lows. So that seems incredibly bad, but potentially could be a tremendous investing opportunity if some super investors like Charlie Munger, Guy Spear, Ray Dalio, and Bill Miller are to be believed. And also it seems interesting when you look back at the financial and stock performance of Alibaba and Amazon, because back in 2017 through 2020, Amazon basically quadrupled in its stock price, whereas Alibaba was almost about to triple in its stock price from 2017 until the infamous speech that Jack Ma gave in October 2020. And we've seen that Amazon's financial performance has only been half as good as Alibaba's, as the revenues of Alibaba have pretty much been double that of Amazon over the last 5 years average worth of financial performance. So I find it really fascinating to try to see if Alibaba will be able to find its way out of being in the doldrums and be able to rise up again, so that perhaps people will put high multiples on its stock price again in the future. But who knows? Only time will tell if these super investors will be right, and if Alibaba will be able to thrive not only in its performance as a company, but also as a stock, as I'm sure a lot of people who might be owning Baba might believe that things can't get much worse than it is now, but we'll just have to see what happens. And if you enjoyed this video or learned something, please like and subscribe, and I wish you well on your journey to being the best investor you can be. Till next time.